Hello, this is Eric Parnell, Chief Market Strategist from Great Valley Advisor Group. Well, the trade war is over, but only if the current administration wants it. It was at the beginning of April when we saw the new administration announce tariffs that were much higher than expected against countries all around the world. But in the time since, we've seen the market absorb what's taken place, we've seen the administration adjust its approach, and we've seen a calming that's taken place not only across the equity market, but across capital markets all across the spectrum. We've seen a strong rally in the stock market that has continued particularly over this last week, and we've made some important technical progress along the way. The first key step was a decisive breakout above the 20-day moving average on the S&P 500. This is important because this was key resistance for the US stock market going all the way back to the February highs. We'll want to keep an eye out for further progress for the market in the weeks ahead, as we have the 50-day moving average and the 200-day moving average that still looms as resistance. But with some of the indicators that we're about to discuss, we have good reason for optimism that the market should be able to continue its way higher as we progress through the second quarter. So what are these indicators that give us cause for optimism? The first is the VIX, or the CBOE Volatility Index. This is known as the fear index. Basically, the higher this reading goes, the more investors are concerned. And the lower this reading goes, the more investors are feeling better about the investment outlook. What have we seen here over the past month? The VIX spiked as high as 60, a reading we've only seen a couple times since the turn of the millennium. But once the 90-day pause was announced, we've seen the VIX come steadily down. It's come all the way from 60 down into the low 20s, and if it continues into the high teens, that's a sign that the market is getting increasingly comfortable that the worst is now behind us. Two other indicators that give us cause for encouragement: direction of the 10-year Treasury yield and the US dollar. One of the things that was taking place at the height of the trade war outbreak at the beginning of April, we saw a dramatic rise in the 10-year Treasury yield at the same time that we saw a precipitous drop in the US dollar. Why was this a problem? Because the rise in the 10-year Treasury yield signaled that investors were selling US Treasuries, and the fall in the dollar indicated that investors were taking that money and leaving the United States. That's bad for capital markets here in the US, and it signals uncertainty around the rest of the world. Well, what have we seen more recently? We've seen the 10-year Treasury yield hit a peak, and it's been making its way steadily back lower, back into the range that we were in prior to the outbreak of the trade war. At the same time, we've seen the US dollar index bottom, and it's been making its way gradually higher in the days since. This is a signal that we're seeing greater reassurance that this may all resolve itself without much further incident. We'll need to keep an eye on this in the weeks ahead, however, because although the administration has backed off in its current trade rhetoric, there's still a lot of deals that are potentially going to be made between now and the end of the 90-day pause window that was recently put in place. How about some of the other indicators that are giving us encouragement? One of the key downside risks that we've been talking about going all the way back to the summer of 2023 was the potential renewed rise in inflation. Now, the announcements of tariffs amplified this concern because tariffs, after all, are inherently inflationary. But what has the market been signaling since the outbreak of the trade war? It's not been a concern about a renewed rise in inflation. Instead, we've seen inflation expectations come down. Why has this been the case? Because investors are more concerned about the potential for an economic recession being disinflationary, if not deflationary. Now, we don't like to see an economic recession, but this outcome on the inflation front is encouraging because it gives the US Federal Reserve the flexibility to cut interest rates in a recession if need be. And one of the things that we've learned over the last 17 years since the financial crisis is US investors and global investors love it when the Federal Reserve cut interest rates. Another key indicator here to watch is one that we're going through right now. It's first quarter earnings season. And one of the key concerns that many had going into earnings season was that corporations would be cutting their outlook because of all of the tariff uncertainty. But what have we seen so far, 1/3 of the way through earnings season? Not only are corporations not cutting their outlooks on aggregate, they have actually been increasing their outlooks on aggregate. Basically saying, hey, if this tariff situation diffuses itself over the next few weeks, we feel pretty good as companies in the S&P 500 index about the outlook in the weeks and months ahead. It's been a tumultuous month of April. and there's a lot of volatility that has put investors on the back foot. But the good news is that through all the noise, the underlying fundamentals for the economy and the financial markets continue to remain strong. Now we're likely to see turbulence in the weeks and months ahead because there's still trade negotiations that need to be worked out, and there's still a lot of uncertainty that investors are coping with. This all highlights the importance of sticking to your long-term discipline. We're going to see bouts like this as we continue through the rest of the year, just like we've seen periods of volatility like this in the past, going back over years and decades. It's all a part of the investment process and the idea of taking on risks to get a higher return. Stick to your long-term discipline. Recognize that these periods of volatility are going to take place along the way, and stay the course in looking to achieve your long-term goals. Thanks for joining me for this latest Market Insight, and I look forward to seeing you again soon.